So Lee, we're starting to see more mergers now in the oil fields.
Yeah, we are.
Uh, the consolidation happens for a simple reason. I know these companies are a little bit different from each other, upstream, downstream, production,
Sure.
exploration. But listen, basically, they're all brothers and sisters or first cousins of one another. So,
In some way, shape, or form, they sure are.
so the fact that you're getting roll-ups in industries where you've got related companies isn't that surprising.
No.
But what's new? What's gone on there in the last few months?
Well, nothing the size of like when Mobil was purchased by Exxon and merged in. But Conoco recently announced, and this is ConocoPhillips, the symbol COP. They recently announced that we're going to lay off astonishing 20 to 25% of their workforce, which translates to a fair amount of jobs. Let me check my data on that, but I think it translated to, let's look real quick. Okay, that translates to about 3,200 people, which is a pretty big layoff. And they recently purchased a Marathon, a simple MRO. So they did it, and that's probably one of the reasons for these, because you're getting rid of duplicated, positions. But yeah, I mean, 20 to 25% of your workforce is a big hit. And the tech guys have been quietly laying off people for the last 3 years, big chunks of people. And so the question has to be, especially with the job market where there's now, it had been out of balance to the good side, but now there's more people unemployed than jobs out there, posted jobs. So that used to be the other way around. There was more jobs than people to fill them. So I think what this is quietly telling us is that the economy is in for some trouble. Now, whether it's going to be anytime soon or next year, but I think we're in trouble. And I think a lot of the indicators that, market mavens look at, like Mike Hartnett, I just wrote an article on this recently. He says, hey, this is about as overbought as it can be. So where do you go next?
Yeah. I have a rule of thumb, and that is that if you see a merger between two companies that are basically very, very closely related, you
Very
can figure
close.
between 10 and 20% of the people will be laid off. That
Yep,
will help increase earnings. Now,
absolutely.
boards of directors are often stupid, which means that the merger sometimes the fundamental merger doesn't make any sense, right?
No,
But my rule of thumb as an investor is if I see two companies that are similar to each other that are merged, take that workforce and give it a major haircut in terms of
yep,
what happens to the expense side of earnings.
yep.
I think it's a good rule to live by.
It's a very good rule to live by, and it's always proven to be correct. I mean, another huge energy deal that is finally going to close after 2 years plus of wrangling will be Chevron's purchase of Hess.
A
Now,
pass, yeah,
Hess, for people that don't live on the East Coast, Hess is a much bigger player on the East Coast of the United States. But this is a very similar merger of equals. And, but Hess also, like Marathon had, has a big uh, energy services side, and it'll be interesting to see if they, and Hess owns part of it and other people, but that's another positive thing for Chevron to add into their huge web of products that are offered. So yeah, it's going to be interesting to see if there'll be more, because these are big deals.
huge.